If you're in your 20s and you're not investing yet, this video is going to show you exactly what that decision is costing you. Not in a guilt trip way. Not in a you should have started yesterday way. In a cold, hard math way. Because the numbers behind early investing are so powerful that once you see them, you can't unsee them. And if you're thinking, I don't have enough money to invest, or I'll start when I'm more stable, stay with me, because those are exactly the thoughts that keep people from building wealth. And by the end of this video, you're going to understand why starting small and starting now beats waiting for the perfect moment every single time. Welcome to centsmart, where we make personal finance simple for people who are just getting started. Subscribe if you haven't already. New videos every week. Let's get into it. First, let's talk about the single most powerful force in personal finance. It's not your salary. It's not your job title. It's not even how good you are with money. It's compound interest. And in your 20s, you have more of it available to you than you will at any other point in your life. Here's how compound interest works. You invest money. That money earns a return. Then you earn a return on your original money and on the return you already earned. Then you earn a return on all of that. And so on, every year, for decades. It sounds simple, but the effect over time is staggering. Let's look at two people. Call them Alex and Jordan. Alex starts investing at 25. She puts in $200 a month and earns an average annual return of 7%, which is a conservative estimate for a diversified stock market investment over the long term. She invests for 10 years and then stops completely at age 35. After that, she never adds another dollar. Jordan starts investing at 35, 10 years later. He puts in the same $200 a month at the same 7% return. But unlike Alex, he keeps investing all the way until age 65. Now here's the question. At age 65, who has more money? You'd think Jordan. He invested for 30 years versus Alex's 10. He put in significantly more money. Surely he wins. He doesn't. Alex, who invested for just 10 years and then stopped, ends up with more money at age 65 than Jordan, who invested for 30 years without stopping. Alex invested $24,000 total. Jordan invested $72,000. But Alex ends up ahead because her money had an extra 10 years of compounding. This is the power of starting early. Time in the market matters more than the amount you invest. And your 20s are the most valuable investing years of your entire life. Every year you wait to start investing costs you, not just in the money you don't earn, but in the compounding those returns would have generated for the next 40 years. Now let's talk about the most common objection. I don't have enough money to invest. And I want to address this head on because it's the single biggest reason young people don't start investing. And it's based on a misunderstanding of what investing actually requires. You do not need thousands of dollars to start investing. You do not need a financial advisor. You do not need to understand the stock market in depth. You need as little as $1. Many investing apps today, Fidelity, Charles Schwab, and others, allow you to open an account with no minimum balance and buy fractional shares of stocks and funds for as little as $1. The amount matters less than the habit. Investing $20 a month is infinitely better than investing $0 a month. Because $20 a month builds the habit, builds the knowledge, and starts the compounding, even if the dollar amounts are small right now. As your income grows, you increase the amount. But you don't wait for the income to grow before you start. You start with what you have. Now, let's talk about where to actually invest, because this is where most beginners get paralyzed. There are thousands of options, and the financial industry loves to make it seem complicated. It doesn't have to be. For most people in their 20s, the best starting point is one of two things: a workplace retirement account or a Roth IRA. If your employer offers a 401k or similar retirement plan, and especially if they offer any kind of employer match, that is your first priority. An employer match is free money. If your employer matches 50% of your contributions up to 6% of your salary, that's an instant 50% return on that portion of your investment before the market even does anything. No other investment in the world guarantees that kind of return. Always contribute at least enough to get the full employer match. If your employer doesn't offer a retirement plan, or after you've captured the full employer match, the next best option for most people in their 20s is a Roth IRA. A Roth IRA is an individual retirement account that you open yourself, separate from your employer. The key feature is this: you contribute money that has already been taxed, your normal take-home pay, and then all the growth inside the account is completely tax-free. When you retire and withdraw the money, you pay zero taxes on it. Zero. Not reduced taxes. Zero. In your 20s, you're likely in a lower tax bracket than you will be later in life. Paying taxes now at a low rate and then never paying taxes on the growth again is one of the best financial decisions you can make at your age. The annual contribution limit for a Roth IRA is $7,000 as of 2024. You don't have to contribute the maximum. Start with whatever you can, even $50 or $100 a month, and increase it over time. Now let's talk about what to actually invest in. Because once you open the account, you have to choose where to put the money inside it. For beginners, the answer is simple: index funds. An index fund is a type of investment that tracks a broad market index, like the S&P 500, which represents the 500 largest companies in America. Instead of trying to pick individual stocks, which is extremely difficult even for professionals, you buy a small piece of all 500 companies at once. Index funds have three massive advantages for beginners. First, they are diversified. Your money is spread across hundreds of companies, so if one company performs badly, it barely affects your overall return. Second, they are low cost. Because they simply track an index rather than being actively managed, their fees are extremely low, often less than 0.1% per year. Compare that to actively managed funds that charge 1 to 2% and usually perform worse. Third, they work. Historically, a diversified index fund tracking the U.S. stock market has returned an average of 7 to 10% per year over the long term. That's not guaranteed. Past performance doesn't predict future results, but it's the most reliable long-term wealth-building tool available to ordinary investors. Two of the most popular index funds for beginners are VOO, which tracks the S&P 500 and is offered by Vanguard, and FXAIX, which is Fidelity's version of the same thing. Both have extremely low fees and decades of strong performance behind them. You don't need to understand everything about how they work. You just need to know that buying and holding a broad market index fund over decades is the strategy that has worked for millions of ordinary investors. Now let's address the fear of losing money, because this is the second biggest reason young people avoid investing. What if the market crashes and I lose everything? Here's the honest answer: the market will crash. At some point during your investing lifetime, the market will drop significantly, maybe 30%, maybe more. This has happened multiple times throughout history. And every single time, the market has recovered and gone on to reach new highs. If you're in your 20s and the market drops 50%, that is not a disaster. That is a sale. Every dollar you invest during a market downturn buys more shares at a lower price, shares that will be worth significantly more when the market recovers. The only people who permanently lose money in a market crash are the people who panic and sell. If you stay invested, the crash is temporary. If you sell in a panic, the loss is permanent. This is why time horizon matters so much. You are not investing money you need next month or next year. You are investing money you won't touch for 30 or 40 years. In that time frame, short-term market drops are irrelevant noise on a long upward trend. The biggest risk in investing isn't losing money in a crash. It's not investing at all and missing decades of compound growth. Let's also quickly talk about what to do if you have debt. Because a common question is, should I invest or pay off debt first? The honest answer is, it depends on the interest rate. High-interest debt, credit cards at 15 to 20%, should be paid off before investing beyond your employer match. No investment reliably returns 20%, so paying off a 20% debt is the better financial move. Low-interest debt, student loans at 3 to 5%, can be paid off gradually while you invest simultaneously. The expected long-term return of the stock market is higher than a 4% interest rate, so investing while slowly paying off low-interest debt is mathematically sound. And always capture the full employer match before paying off any debt. That match is a guaranteed return that beats both debt payoff and investing. So let's bring it all together. Compound interest is the most powerful force in personal finance. And time is the key ingredient. Starting in your 20s gives you a massive advantage that no amount of money can buy back later. You don't need a lot of money to start. Start with whatever you have. Open a Roth IRA or contribute to your workplace 401k. Invest in low-cost index funds and leave them alone. Don't panic when the market drops. And increase your contributions as your income grows. The best investment strategy is the one you start today and stick to for decades. Not the most sophisticated one. Not the most complicated one. The one you actually do. Your action step today is simple. Open a Roth IRA or log into your workplace retirement account and make sure you're contributing at least enough to get the full employer match. That one action, taken today, could be worth hundreds of thousands of dollars by the time you retire. If this video helped you understand investing for the first time, please subscribe, because every week we break down personal finance in a way that actually makes sense for beginners. Our full playlist is linked in the description. Watch them all and build your financial foundation one video at a time. I'll see you in the next one.